ETFs, or exchange-traded funds, are a type of investment fund and exchange-traded product with shares that are tradable on a stock exchange. They are designed to combine the characteristics of both stocks and mutual funds. Here's how ETFs work and some key features. Structure: ETFs pool money from multiple investors to buy a diversified portfolio of assets, such as stocks, bonds, commodities, or a combination of these. The fund's ownership is divided into shares that are bought and sold on a stock exchange, just like individual stocks. Diversification: ETFs offer investors exposure to a broad range of assets or a specific sector, index, or commodity. This diversification can help spread risk. Liquidity: ETFs can be bought and sold throughout the trading day, just like individual stocks, which provides flexibility to investors. The market price of an ETF is determined by supply and demand, so it may trade at a premium or discount to its net asset value, NAV. Transparency: ETFs provide daily disclosure of their holdings, allowing investors to see the assets they own. This transparency helps investors make informed decisions. Low costs: ETFs often have lower expense ratios compared to traditional mutual funds, making them a cost-effective investment option. This is due in part to their passive management style, which aims to track an index rather than actively selecting securities. Tax efficiency: ETFs can be tax efficient because they typically have lower portfolio turnover compared to actively managed funds. This can result in fewer capital gains distributions. Flexibility: investors can use ETFs for various investment strategies, such as long-term investing, short-term trading, hedging, or as building blocks for a diversified portfolio. Types of ETFs: there are various types of ETFs, including equity ETFs. These track a specific stock market index or sector, such as the S&P 500 or technology stocks. Fixed income ETFs. These invest in bonds and provide exposure to various types of fixed income securities. Commodity ETFs. These track the performance of commodities like gold, oil, or agricultural products. Currency ETFs. These provide exposure to foreign currencies and their movements relative to the investor's base currency. Inverse ETFs. These are designed to move in the opposite direction of a specific index or asset. They are often used for hedging or short-term trading. Leveraged ETFs. These aim to amplify the returns of an underlying index or asset using financial derivatives. They are riskier and more suitable for experienced investors. It's important to note that while ETFs offer many advantages, they also carry risks. The value of an ETF can go up or down based on the performance of the underlying assets, and they are subject to market volatility. Investors should carefully consider their investment objectives, risk tolerance, and research the specific ETFs they intend to invest in before making any decisions. FAQ section. What is an ETF? An ETF, or exchange-traded fund, is an investment fund and exchange-traded product that combines the features of a mutual fund and a stock. ETFs hold a diversified portfolio of assets, such as stocks, bonds, or commodities, and their shares are traded on stock exchanges. How do ETFs work? ETFs work by pooling money from multiple investors to purchase a diversified basket of underlying assets. These assets are divided into shares, and these shares are then listed and traded on stock exchanges, allowing investors to buy and sell them like individual stocks. What are the benefits of investing in ETFs? Some benefits of investing in ETFs include diversification, liquidity, transparency, low costs, tax efficiency, and flexibility. They can provide exposure to various asset classes and investment strategies. Are ETFs only for long-term investors? No. ETFs can be used by both long-term investors and short-term traders. They offer flexibility and can be used for a wide range of investment goals, including long-term wealth accumulation, hedging, or short-term trading. How are ETFs different from mutual funds? ETFs and mutual funds both pool money from investors to invest in a portfolio of assets. However, ETFs are traded on stock exchanges like individual stocks, while mutual funds are bought and sold at the end of the trading day at the net asset value, NAV. ETFs often have lower expense ratios than actively managed mutual funds. Can I buy ETFs through my brokerage account? Yes. You can buy and sell ETFs through a brokerage account, just like individual stocks. They are traded during regular trading hours on stock exchanges. Do ETFs pay dividends? Many ETFs distribute dividends to shareholders, typically on a regular basis, e.g., quarterly. The amount and frequency of dividend payments depend on the underlying assets held by the ETF. Are ETFs suitable for retirement accounts like IRAs and 401ks? Yes, ETFs can be suitable for retirement accounts. They provide a wide range of investment options, and their flexibility can be valuable for constructing a diversified retirement portfolio. Are all ETFs passively managed? No. While many ETFs are passively managed and aim to track the performance of an index, there are also actively managed ETFs where fund managers actively select and manage the underlying assets. What are the risks associated with investing in ETFs? ETFs carry risks such as market risk, liquidity risk, and tracking error risk. The value of an ETF can fluctuate based on the performance of the underlying assets. It's important for investors to understand these risks and do their research before investing. Can I use ETFs for diversification in my investment portfolio? Yes, ETFs are an excellent tool for diversification. They provide exposure to various asset classes and sectors, allowing investors to spread risk across a broader range of investments. Thanks for watching.